Are you an early stage founder revolutionizing the future of retail? Then you're in the right place. My name is Shah, and I'm an angel investor investing at the pre-seed stage in retail tech, e-commerce, and digitally native brands. I'm also the founder of Retail X Series, an in-real-life event series based in New York to help early-stage founders think through topics like customer acquisition, sales pipelines, branding, financial modeling, fundraising, and more. In this podcast, I interview founders and investors who've spoken at Retail X Series events in the past, and we dig deep into the tactics around key topics that early-stage founders want to hear about. Welcome to the Retail X podcast. Hello, everyone. Welcome to the Retail X Series podcast. I'm your host, Shah. Today's episode is all about getting ready to fundraise for your first outside capital. Our guest today, Del Johnson, is a principal at Backstage Capital. Del will give us his advice, tips, and best practices for fundraising. Welcome to the podcast, Del. So let's start with some background. Del, can you tell us a little bit about you and your background?
Sure, absolutely. My name's Del Johnson. I'm a principal at Backstage Capital. I scout for NDVC. I do a lot of other venture work here in New York. I'm originally from California. I came to New York 5 years ago to go to Columbia Law School. Didn't know much about venture then, but ended up taking a class at Columbia Business School called Intro to Venturing, where I learned about venture, thought maybe I could be good at it, decided I did not want to be a lawyer, and ended up rejecting my big law firm offer in order to go straight to venture after I graduated. Before that, I was in the Silicon Valley working with big tech companies. I was at Oracle. I did business-to-business sales and business development, and then moved over to work with Google doing software engineering recruiting. Before that, I was in college at UC Berkeley, and I've been doing this now for almost 2.5 years.
That's great. So thanks for sharing your background. Moving more towards the investing activity and the things that you're working on now, can you tell us a little bit more about Backstage Capital, what your investment focus and the sweet spot is, typical check size, all of those sorts of things?
Yeah, Backstage Capital is a pre-seed and a seed stage VC fund that's focused mainly on underrepresented founders. So those are founders that have traditionally been overlooked by venture capital. Think of Black founders, Latinx founders, LGBTQ founders, and all women founders. It was created by Arlen Hamilton a few years back. She was someone who was an outsider to venture capital, and she saw that there was a huge hole in the market when it came to firms servicing these founders. And so she went out to fix it. And in that time span, we've invested in over 100 companies, usually all at the early stage, agnostic as far as vertical goes. So we've invested in everything from B2B SaaS to hardware to CPG, really just looking for anything that is venture backable. And we are agnostic as far as region goes as well. It's a Santa Monica-based fund, but even our investment team and many of our team members sit remotely. I'm here in New York. I've been the only member of the team out here in New York since the organization was built. And we really just try to scour the globe looking for great companies started by overlooked founders.
Thank you. That's very helpful in terms of kind of what you're looking for. You in particular, I think, have maybe a different view on early stage startups than some of the other investors that I've met. What is the most important to you when evaluating startups? I know you have thought one thing in the past and you've kind of moved on to where you are now. Can you talk a little bit about that?
Yeah, I'm always in a state of flux, and I'm unsure if there's actually one thing that is the rules above everything else. Every startup is different, and successful ones are likely to be different in various ways. Usually the way that investors think about how to evaluate a business opportunity is either by the strength of the team, the size of the market and the market potential, or the strength of the product. And so there are good arguments for each one. I used to believe that it was all founder, and I probably still do. I think founder quality is of the utmost importance. I was reading a blog by Mark Andreessen back in 2007 where he basically says it's actually all market, because if a mediocre team meets a good market opportunity, you'll get a market pool where it doesn't really matter if the team is subpar. There's such a need for the product that the customers will lead them in the right direction. I think there's some truth to that, but I still think, especially now when we have more and more competition within the space, that it's important that the founders are uniquely situated to solve the problem. But also, I think that we overlook the ability of the founder to identify the problem. And so, to me, market and team quality are nearly inextricably linked, because market team is the arbiter of what market that they are going to pursue. And that takes skill to understand what market is going to bring you pull. So maybe I have kind of a hybrid combined answer, or maybe I'm moving completely to market. I'm unsure.
I love it. Okay. But that all makes sense. But you also mentioned the words venture backable. So for the founders that are listening to this podcast, what do you mean by a company that is venture backable?
Yeah, so venture is very specific. It's risk capital. It's we give you a little bit of money, we take a piece of your company, and then we hope that money multiplies. And so if you're in a business where you can't multiply investor money many times over, we're talking 10 times over, 100 times over. If you're not able to do that, then maybe venture is not for you. There are different types of business models, and you can be profitable, well off, have a great company without necessarily having a huge company. And you can have a huge company without the necessarily needing risk capital. So it really just depends on your unique situation. But I think a mistake that founders make is going to VCs when their business model is really not conducive to raising venture money.
Thanks. And then, if you're thinking about that at the earliest stages and a founder comes to you and they have some level of a business model that they believe is venture backable, but they're at that pre-seed or kind of first early capital, how much traction are you looking for? And do you see metrics at that early stage that maybe kind of show you a growth trajectory that might prove out that this is a venture backable company and a company that you might want to invest in?
Yeah, that takes, sometimes it takes deep research, sometimes it takes expertise. So a lot of times VCs will verticalize. Now, I'm part of generalist institutions and my leanings are in a generalist direction, but part of the reason that funds will verticalize is so that they can understand what a market opportunity looks like without necessarily the companies that they invest in being completely proven out. Right, because a lot of times, especially in hot or competitive markets, by the time that it's proven that a company can execute or is venture backable, it may be too late to invest in them. But there are some concrete things that you can look at in order to understand, if the company is going in the right direction. One of the things that you mentioned is the growth trajectory. So how much are you, if you are in market, how much are you growing? Even if it's a small amount, even if it's, a few $100s, a few $1,000s, just actually having customers and there being some sort of growth there and spread of the idea can be very important. You can have a provable beta test. You could have run experiments to see if there is some sort of product market fit. Usually at the pre-seed level, though, you're not going to be at full product market fit, but there needs to be some indication that you can get there. And the best way is to have people who want your product and to demonstrate that they do somehow. It does not necessarily have to be revenue generation, but there needs to be some evidence.
That's very fair. And I think one of the things that a lot of founders come to me and ask is, is this enough traction? Is this, you know, how do I get traction if I don't have any money to get traction? But it sounds like what you're saying is that even a little bit of traction, a little bit of growth proves out something at these early stages and is a useful marker or metric for investors.
That's right. That's right. There are a lot of things in this world that if you offered to people, they would say yes because the value proposition is so compelling, even if you didn't have the thing in hand. So sometimes it's not a good excuse to say that you're caught in a catch 22 because, you need money to build the product. You can't build the product because you can't get money. You can't get money because you don't have a product, et cetera, et cetera. You're just in a cycle and it can never be fixed. Sometimes that's true. Sometimes that's true. And a lot of good companies have died. Or potentially great companies have died because of that. But a lot of times, probably the majority of times, it's not true. Right? Sometimes you can ask people, hey, if I build this, will you pay? Will you prepay for this? And I promise you that I'll build it. I mean, a less extreme version of that is actually just taking a survey. Would you want this if I built this? Like, give us some indication that this is actually something that people want, because it may just be something that you want as a founder. And a lot of founders, and this is old stuff. This is like Paul Graham stuff, YC stuff. They theorized this a decade ago, but still founders make the mistake of building things that don't have a market fit. And so it's really important, not just for investors, but for you. If you're going to sink all your time into something and you really think that it's a great opportunity, then you need to be sure that it's something that's going to be able to sustain you if you want it to be a business and not just a personal project of yours.
That's great advice. So getting back to kind of now process of fundraising. So when you first have a call or a meeting with an entrepreneur, what are the questions that you ask most often in that kind of first conversation?
Yeah, first conversation, like a telephone call, usually comes after a pitch deck review. So I've already looked at the company idea and then determined that it probably is viable. That doesn't necessarily mean that we're ready to jump on it and invest, but it means that we're interested in and we want to learn more. So when you get on the phone, I think what I'm looking at, because I've already kind of sussed out whether the business opportunity makes sense, the main thing I'm looking at is, are you uniquely qualified to solve that problem? Because people can identify problems, but that doesn't mean that they can solve them. And sometimes founders think that problem identification is the end all and be all of company building, right? There's this large market opportunity. If we just execute on this amount of it, then we'll make this much money. But they don't realize all the other competitive pressures that come along with building a company, and that even if they're first to the idea, that a stronger team can come along and wipe you out in many instances. And so there needs to be some assurance that this person is the right person to build this, is the right person to marshal a team, right, with the expertise to plausibly be a market leader. And and then the other part is questions, any remaining questions that I may have. You might have an interesting idea generally, but usually a good deck doesn't get into every single specific. So if I have some questions around, how does the business model actually work in practice? If they have revenue, where is it coming from? What are the levers that drive the business, et cetera?
And you mentioned the deck and the questions that have been answered in the deck. What makes a good deck that actually gets that entrepreneur that first call or meeting? Does it have to be like pretty and branded? And how is it worth kind of for an entrepreneur to spend a lot of money on it? We all know kind of what it should be, around 12 slides, and it should kind of, to your point, talk about the problem and the solution and the team and the market. What else are you looking for from that deck so that you will take that call?
I haven't seen a 12-slide deck in a while. Most are like 20 plus.
That's true.
But is that a rule? I've never seen 12.
I think we're supposed to have 12, and I have never seen an entrepreneur stop at 12. Let's put it that way.
Yeah, I've never seen less than 12 unless it's a one pager. So not a lot. You shouldn't pay a lot. I mean, it's nice to have things look good. But some investors, some savvy investors actually look for decks that aren't well designed. They're like, these people are folks that are just building their business and so they don't have time for deck design. I don't know which way it goes. I do know that, when I was working for Google and we were evaluating software engineering applications, a lot of the best software engineers had resumes that were written in like Comic Sans, and they had Yahoo email addresses. Basically, every rule that people said, don't break, they broke as far as presenting a resume. So there could be some truth to like badly styled decks are indicative of better quality founder, but I wouldn't hang my hat on that because VCs like pretty things. And so regardless of what the actual case is, you probably do want to lean towards having something appeasing, good looking to the eye, so that you will grab and maintain the attention of an investor. But don't pay like $20,000 if you're a pre-seed company, you're not making any revenue, and a designer comes to you and says, "Pay me $20,000." Don't do that. Find a way to get it for the cheap. There are a lot of templates online that you can use just to get a conversation going. I think people put too much importance on the deck, but it's not important. But do not spend too much time making it, because the content is the thing that matters the most. So you can make something look as pretty as it can be, but if there's not a solid venture backable idea, then it's not going to be something that investors are going to be interested in.
That's good advice. So the other piece that is a controversial topic amongst the retail X kind of community is the financial model at the pre-seed stage. How important is a financial model to you when you are evaluating a company?
It's not that important. You want to understand that the founder understands what drives the business, and that is the importance of a financial model in the early stages. It has really little to do with the actual numbers behind it, insofar as those numbers are plausible. Sometimes the numbers aren't plausible at all, and you know that the person doesn't really understand their business, or the numbers don't really match their strategy. They're getting money from places that they did not indicate would be drivers of the business, maybe in the pitch deck or in the conversation. And they just kind of seem to be flailing and saying, you know what, we'll just make money every which way, which is usually not how venture scale businesses work. You usually have some main revenue driver.
So much more important to understand the levers versus like the massive spreadsheet full of 5-year projections. Would you say that that's fair?
Yeah, I think that's what VCs say. So I think that's fair. There's two ways to think about like building a company. One is, what are the things that I can do to actually be successful in building the company? And then the other one is, what are the things that I can do to impress investors? And when one conflicts with two, you should always do the thing that helps you build your company. Don't ever gear your presentation of your company to investors if it's actually going to hurt the operation of the company. I think people spend too much time trying to appease investors. First off, like, investors are different people. I'm much different than most investors, and a lot of investors are somewhat different than each other. And so they have little peculiarities and preferences that sometimes aren't logical and don't make sense. And so you have to understand that, and you have to understand also there's 1,000 seed funds out there. So if someone doesn't like your idea, just go to the next one, the next person, including me. If I don't like your idea, just like go to another fund. Maybe someone else will.
I think it's a really good point about investor founder fit too. And I think we talked about this a little bit at the in-person retail session. And I think you had some strong thoughts about that. I think it's something that a lot of founders don't think about right away is that, if you're just not getting somewhere with an investor, perhaps that's not the right investor for you because they don't understand the business or that market, or they don't believe in you the way maybe another investor might, or maybe they're just the wrong stage or, wrong fit in other ways as well. So I do think that that's something we don't spend a lot of time on talking to founders about it, which is, that there is something there that is a fit with investors, and trying to change your business to make investor A happy is not going to help with investor B.
For the most part, yeah. I mean, there are some things you can do that will appease all investors, but still then, I mean, not all, but you know what I mean, like the majority of investors. There is a thing called investor market fit or valley market fit, which I got from Twitter. But the valley market fit, I already wrote something on investor market fit and never put it out, but then someone else theorized it too. So it is a thing, right? There are things that you can do that basically speak to investors as a class, because investors are very homogenous. I mean, they like to think that they have like quote unquote diversity of thought, but they really, for the most part, all think the same, have FOMO the same, have the same kind of fears, and want to impress their peers in the same way. I don't have that. I have my own things, I'm sure, but I don't have that. But so there are things that you can do, but it depends on if those things have a cost. Like, yeah, if you can do something that appeases investors and doesn't really cost you anything, then that's fine. And even like following up with investors, you can understand that this investor probably just ghosted you because they don't like you or don't like your company. But you can send them an update if BCC them along with 100 other investors. It's very cost free, and maybe you're wrong about your actual identification of what the investor's problem was. Maybe the investor just, they invested in every company that they could for that quarter, and they'll come and look at it again later. Maybe that investor is like going through like challenges, like personal challenges, or the fund's going through challenges, and they come out of it and they're ready to invest, or maybe they're very disciplined about when they invest. So don't think that just because an investor says no, then that's it. I don't want to make that the point of what I just said, but just kind of ratchet down your engagement to a point where you can still build your company.
That's good advice. So, getting back to the process again, as we think about diligence, what other sort of, besides kind of the deck, and you've had a call and you've asked some questions, what other diligence items do founders really need to be ready with at these early stages, and what really happens in that VC diligence process?
So in the early stage, diligence a lot of the time is about the founding team, the ability to execute, and a little bit about the market, and a very, very, very little bit about the product, depending on what the company is and how product heavy it is. Well, it depends on how early you are. I mean, it would be nice if you were incorporated, if you were a Delaware C Corp, if you had all of your legal documents in order, if you had all of your, well, it depends on how, it might just be two people. So I was going to say employee documentation. Yeah, it depends. It really does depend. But I think a lot of it is looking at the founder, digging through their experience, and then asking people, reference check. Does this person execute? Did this person do the thing they said that they did, which is the evidence that we have used to say that there's someone who can actually solve this problem. I think that's the most important part. And then, does the product work? I've seen all three fail. I've seen personal diligence fail, I've seen product diligence fail, and I've seen market diligence fail. Although if market diligence fails, it's usually the investor's fault. It shouldn't have gotten that far. You should know if there's an opportunity there before you promise a company that, you'll invest.
Right. And so let's say you're kind of here, you're feeling comfortable with the team, you've started some of this diligence. Let's talk about valuation. So should founders come to a meeting with you with an idea of valuation or terms?
I like to know what they're raising. I mean, what they're raising is inextricably linked to how they see building their company. So, they'll say perhaps, I'm raising 500K, I'm raising $1 million in order to do X, Y, and Z. And so that's another data point that you can use to figure out if this person really understands, how to build their business. Because if those numbers don't really match up with their vision, then it's going to be hard for them to actually execute on them. So that's why I think it's super important to know. And then also, you want to know if this is actually in your investment sweet spot. So if they're already way past you, or they're raising a lot more money than you have, or a lot less than your minimum check size, that's an important thing to know as well. And also the vehicle is important. Are they raising on a note? Are they raising a price round? Do they have a lead investor? Do they want you to be the lead investor? All of those things are super important because they will affect how the deal goes. And so I think it's important to have a lot of that fleshed out. It doesn't have to be exact, but you should have some idea of kind of what comparable companies in the market are doing, what's the best fit, what is the best fit for what you're trying to build and where you are in building your company, and then be able to communicate that to investors.
And you alluded to this about, is it a price round? Is it a note? Is there a structure that you like best for pre-seed rounds, whether that's a note, a priced round, or a safe? Is there something that you prefer, or does it not really matter to you?
I prefer the thing that's best for the company and the stage of the company. I mean, if a company is a little bit later on, then price rounds make sense. If it's early, then maybe a safe makes sense. It really just depends. It depends on the company and where they are. It's hard to say. It's a little bit harder for me to say because we've invested in so many companies at so many different points in the early stage and in so many different verticals, that some structures made sense for some that wouldn't make sense for others. So it really is a particular thing that's really dependent on where your company is, how many investors you've already gotten, whether you have a lead or not, how much money you're raising. There's so many different particularities that it's hard to say.
That's fair. But let's say that you're running a fundraising process as an entrepreneur, and you talked about this with a lead. In a pre-seed round, and even maybe in maybe a smaller seed, does a lead really matter? Is that something other VCs are going to look for? Do you need to get a lead first before you go and pitch others?
It would be nice if you had one, I think, as far as what VCs look for, because most VCs follow, most VCs don't lead. And so to understand that distinction is important because a lot of VCs will not sign their checks unless they have a lead investor signing their checks. Now, that's not how I do it. That's not how I would do it or work for a fund that would do it, I say, and put on tape. It is the way that a lot of funds operate, unfortunately. So if you're talking to someone who can't really commit, then I don't know. It's fine. You have to do what you have to do in order to raise the round. The most important thing is, right, getting the capital that allows you to execute on your vision. So if you can lock up the follow-on investors, and you think that that can drum up support within the investor community to find you a lead, then do that. If you can get a lead first, then do that. I don't think being super hyper targeted in your fundraising is smart, just generally. I mean, there's just too many funds. Unless you're a very strong founder with investor market fit, unless you know that you have it, then trying to pick and choose who are going to be your investors is usually an exercise in futility.
And so, how do you? I'm loving that entire answer, by the way. How how do you then, if you're not going to be targeted about finding your investors, how would you suggest that founders reach out and look for both VCs and angels, to be honest, in these early stages?
Okay, so there's being targeted and then there's like being hyper targeted. Of course, you should be targeted, and targeted just means you pitch investors, you pitch the funds that have the best chance of giving you money, right? And so those are ones that invest in your vertical, that invest in your round, that invest in founders with your background, etc. that's how you're targeted. But when you're trying to pick individuals, that's really difficult to do because you can't really get in the mind of that fund or that individual. You can ask them, but I wouldn't put extra energy into doing that to the expense of all the other funds that are out there that may be able to give you your money.
One of the things we had talked about in our in-person Retail X session was kind of the VC FOMO piece and creating FOMO in investors' mind to try and get to that list of investors relatively quickly. Can you talk a little bit about what you mean by that?
Yeah, FOMO just means fear of missing out. And VCs have it hardcore because a lot of them are high achievers who have been successful all through their life. And so there's a lot of pure envy within the VC community. And a lot of people see it as damaging to their ego if a company comes out that's invested in by all of their friends or all of the folks who they think are strong investors and they never see it, or it happens too fast for them to execute upon it. So you can use that as a psychological advantage in order to drum up support by saying, hey, X% of my round is filled, 60%, 70%, 80%, just keep hammering them. Hey, my round's filling up, you're going to miss out, unfortunately. I mean, you say it in kind of a more suave way than that, but that's the kind of fear that you want to put into them. Oh, I'm talking to, big name investor one, big name investor two. They seem really interested. Let me know if you want to join in. Those kind of things, they work on weak-minded investors, and most VCs are weak-minded. You can, yeah. Well, this is on tape, so I'll stand behind that one.
This is all public, Dell.
Yeah, I'll stand behind that one.
Okay, so thank you. Let's kind of shift because we've just talked a little bit more about process and kind of getting the meetings. How long should an early stage fundraise like this take?
It really depends. Read Elizabeth Yin. Well, read anything written by Elizabeth Yin of Hustle Fund because she really kind of breaks down this whole process. And the truth is that there are really two types of founders. There's the pattern match Silicon Valley founder, the Mark Zuckerberg founder, usually technical, usually a man who investors like because investors are usually men. May or may not be technical, but they look up to technical people. And so, those people usually have a very easy time fundraising. And so if that's the case, then it could take days or weeks to fundraise. But if you're you and you're not that, then you might have to do rolling fundraise. It could take a year, it could take 2 years, it could take 3 years. I've seen it. I've been around long enough where I've seen folks just cobble together around and make it work, because then you have to kind of, if you don't have that investor market fit, then you have to wade through the 1,000 seed funds and find the investors that make the most sense for you and that will say yes. And that can be a difficult process. And then at the same time, you have to be building your company. And so it can be very difficult and very time consuming. So there isn't really one answer. I mean, there's the answer that a lot of VCs will give, but if VCs tell you it takes like 3 months or below, 8 weeks or whatever to raise a round, then they usually just don't understand what the market is like for founders. They're kind of just in their own bubble, and they understand what it's like for those founders, but not the majority of founders.
I'm so glad you said that, because I think, I hear from a lot of founders in the Retail X community who, are dread raising around because they hear from other people that it shouldn't take long, but maybe they're a solo founder and they're, 3 months into it and they're, haven't finished the round yet, and they think, what am I doing wrong? So it's nice to hear that there are a wide variety of outcomes in terms of timing for a fundraise and how long it will actually take. So what about if a founder is ready to raise money, pre-seed money, but still hasn't quit their full-time job? Is that a negative signal for you?
I mean, I don't know what negative signals are. Negative signals, I don't know why VCs don't understand statistics. I don't know why VCs don't understand a lot of things. Like, negative signal usually means nothing because companies with exponential potential often buck conventional wisdom. They often do the opposite of what the conventional wisdom is. The conventional wisdom gets you to the average. So for me to decline a company because the person works makes no sense if my money can get them to not work and focus on the business. I don't understand it. I don't understand a lot of the rules that people use. A lot of the rules that people use will get you to the average company, and the average company underperforms. The average VC fund underperforms. So why use any rule? I don't have any rule about what a founder should or should not be doing. I want to look at every single case, because any particular single case can be the case that bucks the trend, and that's where you'll find the outsized potential. So, there may be something in the founder background that necessitates them working, right? And that thing, may be coming from an upbringing where they're not from money, that teaches them to be more fiscally responsible, that teaches them to be smarter with their money. That thing might actually be something that is valuable in the context of raising money and building a company. You never know.
I think a lot of people listening to that, or a lot of founders listening to this, are probably feeling a lot better about themselves. I think that perspective is so helpful, and thank you for sharing that. I think it's a question I get all the time from founders, and I think there aren't a ton of VCs who would say, "Listen, if you gotta work," and then that doesn't make a difference in whether I'm going to fund you or not. So I appreciate that.
Well, we should probably just change out a lot of the VCs. I mean, a lot of the VCs kind of come from the same social cultural milieu. And so they're not, they really don't understand what it's like to be an average person. And they don't think average people can create outsized returns, even though the history of our planet has shown the opposite. They really kind of pattern match to their self. And their selves are people usually that have the means to be able to, go think of an idea and then quit their job the next day and go pursue it and be comfortable financially. And that's a problem that, not that those people are in venture, because those people deserve to be in venture like everyone else, but that they're so overrepresented amongst venture capitalists. So there should be those people, and then there should be people who have worked before and who actually understand that the value of a dollar, because it's fairly clear that a lot of VCs don't really understand the value of a dollar. If they did, then the asset class would be returning more than it is right now. So I think that there's a lot of room for diversifying the space in a lot of different ways. I mean, obviously I'm talking about class right now, but race, gender, school attended, region, right? More people from rural areas, more global representation. I mean, right now VC is so homogenous with the same investor type that it's really hurting our industry. Really hurting our industry, and therefore hurting society, because a lot of the things that could be built aren't getting built because they don't speak to the imagination of the typical VC.
I could not agree more. I think that, again, every founder who's hearing that is probably saying, yes, I agree. I thank you for what you're doing and what Backstage Capital is doing to seek out those underrepresented founders of all types. So very much appreciate what you're doing on this front. I want to leave it there, actually. That's a great place to end. I think this has been really eye-opening for me and hopefully for all the listeners. Del, thank you so much for sharing all your advice and your tips on this podcast and your perspective on the state of VC today. I think that it's a perspective we'd like to hear more of from more people. So thank you again. I very much appreciate you coming on the podcast.
Absolutely. Thank you so much for inviting me. And if anyone else wants to hear some of my takes, feel free to follow me on Del Johnson VC at twitter.com. 1L, Del Johnson VC. Thank you.
And thank you for listening to the Retail X podcast. We'll have another new episode out shortly. Thanks for listening. If you'd like to attend a Retail X Series event in person, check out www.retailxseries.com for upcoming events in New York. You can also follow us on Twitter and Instagram at Retail X Series. You can also learn more about me, find fundraising resources, or submit a pitch deck at www.redgiraffeadvisors.com. Thanks, and catch you next time.